Good morning. Welcome to the BF Anderson Techno Fundamental Report for July the 13th. Technical analysis is just looking at different patterns, not necessarily patterns, but charts that give you a feel for where we are in the overall market and whether in a good market or a bad market. And we have to say that our indicators have improved, so I can only tell you what I see. And so what I'm saying here is that we're seeing a lot of stocks that are acting well, and the market, our indicators on the market are acting well. It feels like a bull market to me. I've been doing this for going on 50 years, and I have just kind of a gut feeling about it. So let's look at a few quotes here. In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. So what Peter Lynch is basically saying is that in his early days, when he was managing a lot less money than the latter days, he bought 10 stocks. And he knew going in that not all 10 were going to work. It was going to be 6 out of 10. So it becomes kind of a process of elimination. So once you know that you've got one company in the portfolio, you have to be patient in the process. So in other words, this is a process of elimination. So you buy 10, you know that not all 10 are going to work. So the ones that tend to give you trouble, get them out of the portfolio and go look for something else. There's 8,000 stocks out there. Now, big companies have small moves, small companies have big moves. So what we find very interesting is that most people want to get caught up in the past and buy these companies that are very well known. Take Apple, for example. That's now a $3 trillion company. When we started buying Apple back in 2003, it was $35 billion. It was a smaller company. So again, I must emphasize, you really need to cut your losses short and let your winners run. So if you get a winner in there, don't be too quick to jump off of it. Now, I want to talk about all this talk about the recession. Nobody knows. Peter Lynch says here why you should always ignore economic predictions. Nobody can predict recessions or interest rates. Now, this play, Waiting for Godot, is kind of like it was a play written by Samuel Beckett, a book, very boring, kind of a weird play, but it was two guys waiting for Godot, and Godot never came. So this recession is starting to look like the Godot recession. So as you can see here, all these people are trying to predict, what year we're going to have the recession and so forth. Take it a day at a time. So here we have the total non-farm payrolls, okay? And this is recent. So you can see here in recessions, which are the shaded areas, you get something that looks like this. Everybody has a job. So if you look here, it doesn't look anything like this, and it doesn't look anything like this. It's hitting new highs. So the economy is really doing well. Maybe the Fed's going to be able to do what we need them to do, which is a soft landing. But the main thing to understand, we are in a consumption economy. And so when you look at things like the U.S. Home Construction Index, it's making a new high. So if you really feel that the market would be discounting a recession, why would this particular indicator be so positive? Then we have talk about the banks. We need to take a minute on the banks here. The banks are in a difficult way. Now, the main point of this report, you can pause your video player to read it, is there's going to be a lot of consolidation. There's going to be a lot of banks buying other banks. So the number of banks are going to go down. And I think a lot of people out there think that there are going to be premiums paid for these banks. I don't think so. I think they're going to be forced marriages. And if you look at this particular graph here, this is the regional banking graph. You can see here we're starting to see some improvement. In fact, the trend meter shows that the banks are actually starting to go into a very small uptrend here after moving down quite a bit and sideways quite a bit. So the banks, it's going to be an improving environment because they're going to consolidate. Now, I did want to pick some indicators out that were looking interesting here. This is the new highs on the NASDAQ minus the new lows, looking really good here. This is looking like a bull market to me. You should be getting more aggressive with your portfolio. Now here is the new highs on the S&P. We're up above 60. We actually had 76 yesterday. which I've been saying all along that we've got to get above 60 in order to get this market going, and that's definitely happening. Now, this is the Copic curve. I want to mention the Copic curve one more time. Now, if you realize here, the way the indicator works, you go below zero, back above zero, the bottom of the market is in. Here you go below zero, above zero, the bottom is in. So even though we're right now we're at a reading of minus 162, we need to get above zero. But if you notice here, in every one of these particular situations, once the Copic curve has turned up, the bottom is in. So it's turned up, probably going to cross above zero. We'll continue to watch. The aggression index looking very strong. This is where, you know, when you see a move like this, this is a growth stock cycle. This is where growth stocks outperform. Then we went through 22, which was a disastrous year for growth stocks, but we're seeing some definite improvement here. Aggression index looks good. 3 economic indicators, good news here. We got interest rates backing off. You know, we got the jobs report on last Friday, was below estimates. So the CPI came out on Wednesday, better than expected. So as a result, interest rates have been pulling back. Price of oil starting to creep up here, heading for that 200-day moving average. And just like the regional banks, the financial stocks are showing improvement. You've got to have good, strong financial sector to have a bull market, which I think we're starting to have. New lows on the New York Stock Exchange below 40. Excellent, no problem there. Again, sentiment. Let's talk about sentiment in a second here. You know, we got a lot of, been having a lot of fear. Now, what does that mean? That means there's a lot of cash on the sidelines. So I've seen this before. This was the 08 recession where we came out of it in 09, and then we had a very strong uptrend. This could be the beginnings of an exceptional profitable opportunity because all this cash is sitting on the sidelines and it's fuel to fuel the next bull market. Bonds, this is junk bonds, the high yield corporate bond fund. You can see here breaking out in a big way. That's a super duper positive. Finally, the Renaissance Fund. Now this is a growthy fund. This is all the companies that have gone public in an IPO in the last 2 to 3 years. The fund has been just bogged down, has now gotten into an uptrend, and as you can see here, making new highs. So all in all, things are looking much better. Use the strategy of letting your winners run, cut your losers quick. You need to buy 10 stocks, or the problem is you buy too many stocks, you can't keep up with them. You've got to buy a reasonable number that you can monitor. Let me know if you have any questions. Thank you very much.